Directors' remuneration. This is set by the Remuneration Committee in good corporate governance world. Should be therefore made up entirely of non-executive directors, so that executive directors aren't setting their own salaries. The aim of a remuneration committee is to try and set a pay that motivates and attracts good quality individuals. But don't forget, if it's set too high, then the agency cost will be higher. And of course, as we saw in an earlier recording, we're trying to minimise agency costs for the shareholders who appoint directors as agents to manage their business. But it's a very tough call to make, and as you can see in the media at the moment, a lot of discussion has been focused on this area, and that's very topical. So shareholders are likely to want the following. They want to take a level of risk that aligns with their own risk appetite. The directors, that is. They want to discourage directors from taking excessive levels of risk. They want, however, directors to be encouraged to take a longer term view of the business, bearing in mind that really directors only tend to last for 3 or 4 years at any one business on average. Directors tend to be given high bonuses which tend to be based on short-term goals, although again that is at the moment being discussed in earnest in the media whether that's right, and we should have directors getting money for long-term objectives. Shareholders want to maximise current year earnings, subject to not disregarding the need to have some view on the longer term. So shareholders definitely want these, and some directors want some of them too. Excessive risk can only add a small amount to earnings, in some cases, which should result in a drop in the company's share price because it's just not giving extra value based on the risk taken. Directors, therefore, need to have information that gives them an incentive to manage the company for the short to medium term in order to align themselves with shareholders. But as I say, they only tend to be around 3 or 4 years, so they tend to think short term, whereas shareholders want to think longer term. Salaries, therefore, for directors tend to be basic salary, benefit in kinds such as cars and things, obviously pension, share options, which can be over a period to lock them in, offer them shares in the company itself, so therefore if the share price goes up they will also benefit. A bonus. Now the bonus is what's giving a lot of people a lot of problems at the moment, because they can be a high percentage of the whole package and often given when companies still fail or appear to have made less of a profit than last year. So big topical issue at the moment. Here's some thoughts about what does each element do. So for instance, if you offer basic salary and benefit in kinds, does it discourage excessive risk taking? Well, no, because they get a salary anyway. Profit related pay? Well, no, profits will increase with greater risks, so it doesn't discourage. They'll basically get a higher profit for a higher risk, but it could go the other way. Options and shares, yes, it will affect excessive risk taking, because excessive risk will depress the share price, which if they're paid in will therefore be lower. If you give directors pensions, yes, it will discourage excessive risk taking, because it could bankrupt the company and lose them their pension. And finally, discretionary bonuses, well, it depends on how it's been awarded. As I say, typically it's broadly on short term, high risk, and therefore it won't discourage excessive risk taking. This is what all these other boxes are about, and I'll leave you to work through those. Quite a nice little table to work through. Governance disclosures. Most governance codes require disclosures concerning the following. What are the company's views on sustainability? What reporting are they going to do? Clearly must tell people about the directors, who they are, what they're made up of. Operating a financial review, P&L and balance sheet and those sort of things. It should give reports on from the various board committees. What's been good, what's been bad, what have they found? What's the details of relations with the auditors? And particularly if there's been a change of auditor, why? A statement that directors have reviewed the effectiveness of internal controls and where they didn't work, why, and what they've done to resolve it. There should be a statement of relations and dialogue with the shareholders, so talking to them specifically as a group of shareholders. Should be in the accounting statements, websites, press releases. A statement that the company is a going concern and the director's basis for concluding is a going concern. So it's not the case of the accounts saying so, but what else does the directors say along this line? These are only best practice disclosures. They're not legally necessarily binding. They're not necessarily best accounting standards and therefore requirement, but it's worth noting that's best practice. Talking about practice, well, what is the best code of corporate governance? Well, there's a rules-based and there's a principles-based, and you do need to know what's the difference. Now, a rules-based is where rules are set about how you do something. So for instance, if you're driving along a road and you see a sign that says 50 kilometers an hour, then you must not go over 50 miles an hour. That's the law, that's the rule. Now a principle based would say the sign would look very different. It would probably have 50 miles an hour on it, or 50 kilometers an hour on it, but it will then say if not wet and busy, then the speed limit can be something different. That's what principle-based corporate governance is about. It's saying if circumstances allow, then you can do something slightly different. Okay? So principle-based jurisdictions will develop their own policies and rules that should be followed. In a rules-based approach, any non-compliance is likely to be legally challenged by looking at the intention behind the law. So you look at the law, you must follow the law, and if you try and go outside of it, then there are penalties. Principle-based doesn't tend to have penalties. It just allows you to work within certain guidelines. Okay, so just as a final sort of update, principle-based, you comply or you explain. So like we had in an example before, you had a CEO and a chairman who are the same person, sorry. They had to explain why they'd chosen to do that because they hadn't complied. In a rules-based approach, you either, if that was the rule and you broke it, then you probably get fined for it. So you can't break rules in a rules-based approach. It's much more strict. It cannot be justified on grounds of compliance not being cost beneficial. So very different to a principles base where you can work within certain guidelines. Okay, that's the end of that recording. I'll see you in the next one.